Hey, Steve Saretsky here. Welcome back to the show. Lots to touch on this week, including, most importantly, the Bank of Canada. The Bank of Canada, of course, came out this week opting to hold interest rates firm at 5% on the overnight rate. So they hold rates. There's a lot of commentary, again, post-reaction. Tiff Macklem came out the following day, did a press conference, answered all these questions, and everybody kind of picks and pulls, what they want to sort of affirm their own narratives and their own biases. And so what I'm going to do right now is I'm going to clip directly to Tiff Macklem's comments so you can hear it directly from the source, and then I'm going to chime in with my own commentary or my own opinion interpretation of his comments, which you're going to agree with or disagree with. But let's go directly to Tiff Macklem's comments right here.
We're going to take this one decision at a time, and we're going to take those decisions based on the best available information and analysis at that time. Yesterday, we kept our policy rate at 5%, and we agreed that we were prepared to raise interest rates further if needed. So your next question is probably, well, what is if needed? I mean, what are we seeing? I mean, what we're seeing is monetary policy is working. Inflation has come down significantly. And the economy has entered a period of weaker growth that's needed to rebalance demand and supply and relieve price pressures. But look, inflation is still too high, and we are conscious that the downward momentum in inflation has slowed. And as we emphasized in our policy statement yesterday, we are concerned about the persistence of inflationary pressures. So we are going to be carefully watching and assessing a variety of inflation indicators. I spent quite a bit of time today outlining some of the most important ones. And look, if we come to the conclusion that we haven't done enough, we're prepared to do more, but we don't want to do more than is necessary.
The rate statement Wednesday had several references that could have perhaps fit in with the decision to hike again. Slow progress in getting inflation down, gasoline prices on the rise again, and a risk of an entrenched inflation. Was there much discussion of another hike this week?
Well, you'll receive the summary of deliberations in about 2 weeks, so you'll get a more detailed assessment. I think the clear consensus around the table, I think what everybody could see is, since mid-July, evidence that the economy was slowing, evidence that demand and supply were coming into better balance, that evidence had become clearer. And as I just mentioned in the response to Mark's question, if you look at the labor market, we continued to see gradual adjustment in the labor market, vacancies coming down, unemployment rate ticking up. Clearly, second quarter GDP growth essentially flat. And you also, look at the components of that. I mean, yes, the weakness in second quarter GDP growth, it was magnified particularly by the forest fires that we've seen across this country. But even controlling for that, consumption weakened quite a bit, and you can see it particularly in the interest-sensitive elements of consumption, which suggests that higher interest rates are having traction, and although we are concerned about the persistence of inflationary pressures, as demand and supply come into better balance, that should relieve price pressures, and I think that was really front and center in our decision, both to keep the policy rate at 5% yesterday, and the agreement among the Governing Council that if we needed to do more, we are prepared to raise interest rates further.
So again, basically his commentary is, listen, we've moved to the sidelines. We're willing to do more if we have to. We don't want to do more than we need to, but we're always there. We're willing to do more. So it's kind of like, it was a little bit hawkish. It was kind of like a hawkish hold. We're moving to the sidelines for now. We're going to be data dependent. But the reality is, if you think about it, there's a thing in central banking called forward guidance. And it's one of the most common tactics, particularly for central banks when they got down to the zero bound, right? When you cut interest rates to zero, how do you stimulate? Well, there's not really a whole lot more you can stimulate with other than trying to use your words to get markets to do a particular action. And so the best sort of interpretation of this was to go back to think of the pandemic, right? When the world was kind of like collapsing underneath our feet, shutting down, everyone's scared and everyone's sitting in their houses, no one's spending any money, everyone's worried about job losses in the economy. He comes out and says, listen, we're cutting interest rates to zero. They're going to stay there for a very, very long time. Rest assured, if you want to go borrow money, if you're a household or a business, you can rest assured they will be low for a long, long time. That's him providing forward guidance. And of course, we all know how that played out. Interest rates fell to the floor. Canadians borrowed their brains out, which they're obviously already really good at. And the rug was then pulled prematurely. And we have the fastest and tightest rate hiking cycle in modern history. And so now he's providing forward guidance on the other direction, saying, listen, the reality is there's so much debt in this country that they really can't keep going without just completely destroying stuff. So he has to now provide forward guidance. He can't come out and say, listen, we're done. We're really worried about the economy. And, he has to remain tough, because if he doesn't remain tough, markets will say, hey, listen, rate cuts are imminent. Let's start speculating on real estate again. Let's start speculating on the stock market. The worst is probably behind us. He's telling us things are falling apart. So he has to maintain a hawkish stance. I think they're going to continue to maintain a hawkish stance until it's very, very evident that the economy is in fact rolling over. The job losses are becoming fairly significant, and he has the air cover to know that, okay, inflation for sure is long and gone, and this is turning into the other direction, which we have, potentially have disinflation or deflation happening. And so I think we're still a ways from that evolving, but make no mistake, what we're seeing in housing, I'm getting more and more of these conversations. I had 3 conversations just this past week. People calling me up and saying, listen, I got this debt. I don't know what to do. This is my situation. I had one person call me saying they're cash flow negative. They bought a unit 4 years ago, an investment property 4 years ago. Your cash flow negative $1,500 a month. What do I do? Another person saying, hey, I'm renewing a mortgage. Payment's going up $2,000 a month. What do I do? And so you're starting to see more and more of these conversations, right? Like even people that locked in 5-year mortgages 5 years ago, thinking, these rates are going to go away. They're not my problem. Well, here they are. They are now becoming people's problems, and most people don't pay attention to the Bank of Canada and what's happening in the bond market and interest rates. They just get a letter in the mail and says, hey, your mortgage is up for renewal. Here's your rate. It's now 6.3, not 3%. Because if you think about it, the mortgages that are maturing today, I would say the average mortgage rate in 2018, 5 years ago, was about, give or take, 3%, 3.2, kind of in that number. So you will see a doubling of your mortgage rate. And so I actually gave a very simple sort of example. We did a recording with John Pasalis there in Toronto on the Vancouver and Toronto housing market updates. You'll get that on my channel here probably in the next couple days. But I gave a simple example, which was pretend that you are Canadian household, Vancouver, Toronto, pick your poison, of a mortgage, a $750,000 mortgage, which I would argue in Canada is actually, it's not an unreasonable mortgage, $750,000 on your mortgage. So you borrowed at 3%. 5 years ago. So you borrowed at 3%, you had a 5-year fixed on $750,000. Well, of course, you would have paid off some of your principal over that time. You're now coming up for renewal. Your mortgage payment will increase. Assuming you renew, you were at 3, now you're going to 6.2, which is about today's rate, give or take. And you're renewing that you've paid off the balance, so your mortgage balance is smaller, but you're renewing. So you go from your 30-year AM, you renew at, of course, 25. That's the auto renewal. Your mortgage payment's going to go up by $1,200 per month. That's pretty much the number. So you're going to see a $1,200 a month increase on a what was once a $750,000 mortgage. Now, even if you have the ability and the desire to re-amortize, so you say, well, listen, this $1,200 is too much, so I actually want to increase the amortization back to 30 years. Keep in mind, you have to re-qualify. You have to now pass a stress test at 8.2%. In order to push the amortization back to 30 years. Even if you did that, your monthly mortgage payment would still go up by $900 a month. So more or less what we can say is essentially for a lot of Canadians renewing a mortgage today, you could be looking at about $1,000 a month increase in your monthly mortgage payment. Again, these are with after-tax dollars. So yes, I understand that people have had, increases in their salaries over the last 5 years, but the reality is cost of living has also gone up, right? Your groceries are more expensive, your gas in your car is more expensive, and now you're adding $1,000 a month to your mortgage payment. So it doesn't take, it's not rocket science to understand this is going to bite. The household debt servicing ratio in Canada is going to be hitting all-time record highs next quarter, and it's going to continue to push through as these interest costs continue to mount up. So it's going to take time. Again, I'm really watching this and saying this has the potential to be a really ugly setup. I think recession in Canada is imminent. Looking at the jobs numbers, right? The jobs numbers, the Bank of Canada goes in their conference talking about the jobs numbers. The day after Tiff Macklem's press conference, we get the Canadian jobs statistics. Keep in mind, these job numbers are like so prone to revisions. Remember, we undercounted the population by 1 million people. We found that out just a couple weeks ago. So, these job numbers are bouncing all over the place. But if you kind of look at what's happening, the headline came out today, the day that I'm recording, and it was like, oh, it's not that bad. It kind of beat expectations. And if you just read the headline, you're like, well, see, the Canadian economy is holding up just fine. And then you kind of you look under the hood and you're like, I don't know. Most of the job growth was in construction. I mean, does that add up? We've got a lot of bearish people on housing in this channel. I can tell you what's happening in the construction industry. It ain't pretty. There's a lot of housing starts and new developments that are getting shelved and put on the sidelines. And so you're like, well, is that sustainable? Like, all the employment growth is in the construction sector? We sure about that? But then you unpack the jobs numbers a little bit further. So Canada Jobs Warning. So since January, employment has increased on average 25,000 people per month on average since January. But the population aged 15 and older, i.e. the amount of people that can actually work, has grown by 81,000 on an average of 81,000 average. So given the pace of population growth, right, we're importing 1 million plus people a year, given the pace of population growth, monthly job gains of 50,000 per month. 50,000 is actually what's required for the employment rate to stay constant. Basically, you're adding more supply, you're adding more people into the labor force, more supply, but there's not enough jobs for them. So the unemployment rate. So you've actually looked at the numbers. We've got the population increased by another 103,000 in August, and the unemployment rate held steady. It held steady at 5.5%, but it's risen 0.5 of a percentage point over the last 4 months. And the only time it's done that over a 4-month period was, number one, during the depths of the pandemic, and number two, during the 2008-09 global financial crisis. So the Canadian labor market, it is softening, and keep in mind that these numbers, again, are prone to revisions. They're not considered leading indicators, and I would argue that one of the quickest and easy tells, again, is on a leading indicator basis, is to say, well, is the growth is coming from the construction sector? I would argue that's going to be one of the hardest hit segments as real estate comes under pressure. We already know what's happening in the office market. We know what's coming or is beginning to happen in the residential space. So to me, I find that we're probably fighting the last war, so to speak, on inflation and worrying about the labor market. I just look at this practically about the conversations I have anecdotally, the things that I'm seeing. I think we're starting to see stress in the housing market with people and their mortgage payments. I think a lot of people sort of had their radar on interest rates, but it wasn't necessarily impacting them, or they'll say, well, I'll figure this out. Because again, some of the conversations I've had is, listen, I'm cash flow negative $700 a month on my investment property, but I think rates might come back down in 6 to 12 months. And, here we are, right? Like a year later, and rates are actually higher, and people are going, okay, and this problem isn't going away, and we're getting seeing more and more investors starting to list units. September is going to be a very, very, I think, important time for the housing market. September, October, because this is when you typically get an uptick in listings. And my question is the demand going to be there to meet the uptick in listings? Now, keep in mind, inventory is coming off an incredibly low, almost record low base. So you're not going to have a flood of supply, but I think you're going to get a bunch of new listings coming to market. Not quite enough demand to meet it. It's going to allow inventory to slowly start to build. And as inventory slowly starts to build, it does apply some pressure on pricing. And so, again, mortgage rates more or less have tripled over the last 18 months. I don't think we need to overcomplicate things. So the Bank of Canada can kind of say whatever they want, just like they said they would keep rates low for a very, very long time. I think are now saying how hawkish they're going to be. And again, I'm not calling for imminent rate cuts anytime soon. But I think that the Canadian economy, I think projections for the growth are too optimistic. Assuming that rates stay more or less where they are now and mortgage rates more or less hover in the 6s and the high 5s, I think we're going to run into more and more problems the longer that this goes on. So we'll wait. We'll see. Again, this is just me pontificating. Could be right. Could be wrong. Always do your own due diligence. But this is my interpretation of things that are happening and sort of how I'm trying to at least position myself for what I feel are going to be opportunities over the next 12 months. So as always, hope that helped. See you next week.